How is everybody doing? Welcome to the Strategy Room. You are here with the banker next door. Your host is Dr. Joe Berquist, bringing you another live stream here on this awesome Friday night. Hope everybody had an awesome week out there. I've got a lot of really good stuff here tonight, a lot of things to go over. I guess I'll kind of kick it off here by just doing a quick rundown of some of the episodes that I posted up this week. So what do I have here? So starting over the weekend, last Sunday, I put what I thought was a very interesting episode called Fed Pivot Could Spur More Bond Restructuring. So basically how the interest rates could affect the bond market. So if everybody's looking for a little bit more info on that, I think that's a great episode to check out when you get a chance. Then on Monday, I did what does a successful core conversion look like? Obviously, that's a very, very big deal. It's a very huge topic in the banking world. I've said a lot in the episode that basically there's not much more that keeps a banker up at night than having to go through a core conversion. I think that's like the nightmare of all nightmares for a lot of bankers out there. So that's a great episode to take a look at. Then I did, should you be concerned about your bank board's performance? Like, in other words, if you have a board or director that's basically not, performing up to par, not really carrying their weight, not doing a good job, basically, how do you deal with that? And is it something you should be greatly concerned with? And we get into a lot of different mechanisms that boards can use, basically like age limits, term limits, performance reviews, things of that nature. And then we also get into a little bit of a discussion about, what is the chairman's influence over that? In other words, should the chairman and the CEO, should that be the same person? Should one person be serving both those roles? What kind of effect does that have on the board? So we talked about that a lot in that episode. Then I did on Wednesday, I basically did an M&A update for the third quarter of 2024, kind of what's going on in the M&A world. I'll have a little bit more on that coming up here in just a few minutes when I share a couple articles with everybody. But then in that episode, I also did a kind of a bank merger review. There were two banks that basically announced a recent merger in the Pennsylvania market, Traditions Bank and a bank called ACNB. And those two basically getting together. And I kind of just walk through the process, like how does that work? It starts off with a letter of intent, and then you have an initial offer, and then you kind of go through a negotiation phase. And we talked about a little bit about how those negotiations work, like some of the things that go back and forth. What is it exactly that you're trying to negotiate for? And then we talked about some of the other players that are involved in that. Obviously, attorneys, investment bankers, different people that get involved there. So if you're trying to understand a little bit more about the merger process and maybe just what's going on in the M&A world right now, that's definitely a great episode to check out. Like I said, I will have a little bit more M&A news here in a minute. And then yesterday I did, is CRA concentration, in other words, commercial real estate, is CRA concentration a bad thing? And it really depends. It depends on your bank. It depends on, do you have a niche? Do you have a specialty? The bank that I reviewed in this particular instance is a bank that's out in California on the West Coast, and they had a very specific niche with kind of manufactured homes. And they had been basically working that niche for the better part of the last 30 years. And the bank had really kind of grown up around that particular concentration. So they were heavily concentrated in that one particular area of commercial real estate. But it's something that really worked for them because they really understood that business. They really understood the ins and outs of that particular type of lending to that particular segment of the commercial real estate market. And if that's the kind of thing or kind of setup that you have at your bank, that's okay. Like, that's not really so. So sometimes when I think if you're watching CNBC or something like that, they might be looking at a bank or analyzing a particular bank on a given day, and they might say something like, "Oh, wait, but they've got this huge concentration in commercial real estate, and that's a bad thing." Well, again, it all depends. It depends on what is the makeup there. What is that bank's particular specialty? There are times when there are certain concentrations in commercial real estate. Like, in other words, if I had a concentration right now in super large office buildings in downtown, city centers all over the US, that's a really bad thing at the moment. I probably wouldn't be excited about that. That's a little bit like what happened to New York Community Bank. Up in New York, they had this major concentration of, New York and North Jersey commercial office buildings that just went bad and it turned into a bad thing. So it can be a bad thing, but it doesn't have to be. And sometimes that can be a good thing there. So check out those episodes that I posted. Those were all posted this week from Sunday to Thursday. And then this week coming up, I'm still working on some of these episodes, but I got a couple things coming on. I think I'm going to do an update to the crypto series. Anybody who's been watching any of my crypto series episodes, I've got some stable coin and some other information that just came out. So I'm going to do something on that. I'm definitely going to do an article here kind of on data centers because there's just a lot of news right now with kind of big tech's pivot to nuclear energy. Here in Pennsylvania, Microsoft just signed an agreement with to get 3 Mile Island reopened. If anybody knows, that was the big basically meltdown. It was at 3 Mile Island back in 1980. Netflix actually has a great documentary on it. It's like a 3 or 4 part documentary. So if you haven't seen it, I highly recommend checking that out. It's definitely worth it. I'm going to do an episode on kind of like the changes to fintech partnerships. There's just things coming down the pike there that I really want to talk about. So I'm going to get into that. And I'm going to talk about the collapse of esports. Very interesting article. There was, a company here in Philadelphia called Nerd Street, which I think is, reflective of that industry, the esports industry, if you will. And I thought that, they were kind of this darling a few years ago that was doing really great. And they were, esports was kind of on top of the world. And now all of a sudden it's kind of floundered out. And I thought that was a kind of a great opportunity to do an episode just talking about fads, just things that, things that glitter sometimes and they look great, but then a few years goes by and all of a sudden they lose their luster and it's kind of like, well, oh, that wasn't such a hot investment. That didn't turn out so good. So then, it just fades away and, people are like, oh yeah, glad I didn't invest in that. but at the moment, because if anybody remembers, Comcast had made this big announcement that at least, here in Philadelphia, they were going to build this big esports arena. It wasn't going to be massive, but I think it was going to have 6,000 seats or 10,000 seats, something like that. It was going to be a pretty decent size arena. And it was going to be down where all of the other sports arenas are, like where the Phillies have Citizens Bank Park, the Eagles have Lincoln Financial Field, the Wells Fargo Center, which has the Sixers and the Flyers. So there's that whole sports stadium complex in Philadelphia, and they were going to build it right next to that. And it was, they were going to make, esports this big thing, and it just kind of, fluttered out. So, and now you've got, a lot of retailers, if you were, that were basically, making a lot of these kind of gaming. I don't think you could call them stores, but they were basically like, gaming retail spots where you might have, teenagers or 20 somethings would walk in and basically you could pay and get a membership, or you could just pay for like an hour or two. And then you could just sit down there and they'd have all these, computer gaming terminals. They might have, 20 or 40 or 50, and you could just play against other people that were sitting there playing, or you could play online, or you could kind of do whatever you wanted to. And those things are, I guess it depends on where you're at. Like some of those things are still going good. Some of them maybe not so much, but so I'm going to take, like I said, I'm going to take a look at that in an upcoming episode this week. So like I said, just stick around, check out some of those episodes that I'll be posting up this week. So, okay, so let's get into some news here. I got a ridiculous stack of stuff here to get into, but let's, I always like to talk about, for anybody who's watched any of the other shows before, I always like to start off early by talking about what economic indicators are coming up this week. What's coming out this week? So Monday, the 21st, October 21st, we have the U.S. leading indexes coming out. On Tuesday, October 22nd, we have the API weekly crude oil stock. On Wednesday, October 23rd, we got the export price index, and we get the import price index, and then we get the API weekly crude oil stock. On Thursday, October 24th, we get continuing jobless claims, initial jobless claims, manufacturing PMI, services PMI, and new home sales. And then finally, Friday, October 25th, we get durable goods orders, Michigan consumer sentiment, and then Michigan consumer inflation expectations. And then finally, the U.S. Baker Hughes oil rig count. So good amount of economic data coming out this week. Maybe not as much as the last week or two, but definitely we've got a lot of labor force information coming out. We got some manufacturing information coming out, some consumer and sentiment and inflation expectation numbers coming out. So still some pretty important inflation data and stuff coming out. So All right, let's run through. I'll tell you what, before I get into the other news, let's run through some articles here real quick. Let me bring some things up here. I'm going to come back to this. Was a good one. Investors look to betas to find banking best positions, but for rate cuts. But I'm going to come back to that one in a minute here. I got a couple other articles here I want to run through here. So let's do a commercial real estate check real quick. So this is basically Wells Fargo CEO Charlie Scharf on CRE. Things aren't getting better. And basically Charlie is saying here is that what you see is just more of the significant revelation because of supply and demand. Where's my article here? All right, I got cut off here. All right, so anyway, I wasn't going to spend a lot of time in particular on this article. I just wanted to point out that basically Wells Fargo is saying that they're still seeing some weakness in the commercial real estate sector, specifically office real estate, but things are beginning to stabilize a little bit. Like things, the last month or two, things have not gone down as bad as they were over they had about a 3 or 4 month period there for about a quarter or two where things weren't really going so hot, but now that is kind of rolled off. So now let's look at here. So this was another interesting one. So this was apartment construction boomed in Philadelphia. How quickly are those 15,000 units leasing up? So to take a step here for a second, Philadelphia basically had, and the reason why I'm showing this is because I think this is emblematic of other, major cities across the U.S., whether you want to think of Boston, New York, Washington, D.C., Baltimore, Chicago. Basically, a lot of these cities have gone through big apartment booms, a big apartment building here. Basically, during the pandemic, the building permits especially for apartment buildings just kind of went through the roof. And we had this giant, pipeline, if you will, giant pipeline of basically apartments that were coming on the market that were in the construction phase or were getting built. Now we've reached the phase here in 2024 where the vast majority, almost 15,000 units have now been delivered into the city, brand new, basically high-end apartments. And what this article says is basically they're actually doing pretty good. They've actually reached about a 77% occupancy rate, which again to me is pretty astounding. I did not think that was going to happen, and it was simply because of the price here. And they basically say that if I could find the spot where it talks about pricing here, so. Yeah, so here it says, so monthly rent at a new building is starting around $1,500 for a studio apartment, and ranging up to around $3,000 for a 2-bedroom apartment. And I think affordability, right? That's the big question there. Like how many people can really afford to spend $1,500 on a studio apartment, or how many are spending $3,000 on a 2-bedroom apartment? Those are big numbers. I mean, you can buy a house for $2,000 a month, $2,300 a month. I mean, these are definitely, and I think certain respects more expensive than mortgage payments. But yet, these apartments are still filling up. They're still seeing the demand on there. They're filling up pretty good. I just question. Yes, the leasing up is pretty decent, but I just look kind of down the road and just say, what kind of delinquency rates are these guys going to be looking at in a few years? Are people really going to be able to keep up with the cost of these rents? And as rents continue to increase, because again, you're going to get incremental increases over every year. It's going to go up a little bit. The question is how large are those increases going to be? And then what effect is that going to go on? And then the other question there is, have the landlords made any kind of concessions? In other words, are they like, we'll sign up, we'll give you the first 2 months or 3 months for free if you sign up. So basically they sign you up to a 15-month lease where, you get 3 months free, but you got to pay for the 12 months, that kind of thing, or are we seeing, those kind of concessions in the market right now? So that's kind of my question of what's going on there with that. But like I said, I just thought that, overall, this is, it's a good sign that they've delivered this massive amount of apartment units at least in Philadelphia, and the absorption rate has been pretty good. It hasn't been too bad. So now let's look at two other things. We're going to take a look at, so this is the industrial market, and then we're going to look at the, I think, office market here in a second. But let's take a look. So this is U.S. industrial market vacancy rate hits a 10-year high in the third quarter. So the nation's industrial market continued to slow in the third quarter, building on a 2-year cooling off period after its pandemic heyday, but the market could soon hit bottom. Preliminary data from Civils, if I'm saying that right, found the U.S. industrial vacancy rate hit 7.4% in the third quarter, a 350 basis point increase from 2 years ago. It's also the highest vacancy rate within the national industry market in a decade. So you're starting to see, some vacancy creep up here in the industrial space. What we have seen here in the last couple of years, especially in industrial spaces, that Amazon has really backed off. So your mega spaces, you're basically 500,000 to 1 million square foot, these warehouses that Amazon was just gobbling up like crazy. Amazon has dramatically backed off of that. They're still doing some deals. They're still doing a couple things out here, but they are really backed off of that. And what their main focus is right now is what you call the last mile. They're really focused in on that last mile. Can we get some smaller space to be able to deliver product to people within basically 24 hours? Can we get close enough so that X geography can be delivered to in a 24-hour period of time? That's what Amazon is really keying in on. But what they're really looking at here right now is the space that's 500,000 square feet or below. Like, that's really what is you're seeing the vacancy rate start to really tick up on. So we'll have to keep an eye on this. And let's see here. And this is just a chart, changing industrial market, net absorption and new construction have reversed since the onset of the COVID-19 pandemic. And you can see here, 2020, 21, 22, 23, 24, year to date. You can see net absorption. And then you can see here construction completion square footage, 335 million square feet. 95 million, about 96 million net absorption square feet. So a lot of product coming on there, not as much absorption there. So, okay. And now office leasing demand starts to make a comeback nationally. So let's see what this says. So signs are emerging that companies are feeling more confident about their office leasing decisions, prompting a bump in touring and leasing activity in several U.S. markets. In New York City, there was about 18.6 million square feet of office tenant activity on average in 2018 and 2019, according to data from CBRE Group. At the lowest point of the COVID-19 pandemic, that plummeted to 3.8 million square feet. That's a huge drop. Right now, the firm is tracking 26 million square feet of office requirements in New York, said Paul Myers, vice president of CBRE, who represents tenants in commercial real estate lease negotiating in New York. The numbers are astounding, Myers said. I don't see it abating. So since the pandemic, most of the office leasing activity nationally has been driven by professional services firms and companies in industries like law and finance, which return to the office on a more regular basis and sooner than other industries. Technology, which had been the biggest driver of office leasing activity right before the pandemic, has, as an industry, scaled back its leasing activity significantly since 2020 and has embraced remote work. But in a metro like New York, office tenants in industries like tech, retail, media, and entertainment, which had all been largely absent from the office market in the pandemic's aftermath, are back in a big way. The uptick in leasing demand may be coinciding with a few broader factors, including more certain economy and a bigger push by companies for their employees to be back in the office. I would say that it's the bigger push by companies to get back in the office. I think a lot of companies, you've seen Amazon, you've seen Google, you've seen a number of very big companies basically saying, nope, we want everybody back in the office. We need to bring it back in. Come on back in, guys. So, but the reason why I wanted to show this to everybody was for the overall picture. Okay. We just had the article from Wells Fargo CEO. We just had the article about the apartments. We just had the article about industrial space, and now we're looking at this at office leasing demand. And you can see that, like, apartment net absorption is pretty good. We're seeing in the industrial space kind of an uptick in vacancy, but leasing demand starting to see a little bit more activity there. So commercial real estate not not completely in the dump, so to speak. I have some things going on there that aren't too bad. And like I said, we're starting to see a trend of things beginning to stabilize a little bit, which is good. That's what we're looking for now. But now let's take a look at a couple other things here. 7-Eleven to close more than 400 stores. I believe the number is 440. So 7 & I Holdings, the Japanese parent company of the Irving-based convenience store chain, said the hundreds of closures are due to underperformance caused by a variety of factors. And where's my article? I lost my article again. Anyway, but the important thing here is to note is that why I wanted to show this article is because I wanted to point out Walgreens this week announced that they're going to be closing 1,200 stores, which is on top of the 2,000 stores that they announced that they were going to close a few months back. So now Walgreens is going to be closing 3,200 stores. And so you've had Walgreens closing 3,200 stores, 7-Eleven closing 400 stores. Rite Aid went bankrupt a few months ago. Big Lots went bankrupt. These are just not. It's a very interesting dichotomy, right? Like these are not things that typically happen in a healthy economy. These are not things that happen in an economy where the labor market is booming, so I wanted to show these things because it's the patterns, right? I wanted to point out the patterns here of the different things that we're seeing right now, and then you just had Boeing announce they're going to lay off 17,000 people, so you've got, a lot of things going on here that are not good and not good signs, especially for retail. Not good signs for retail. And we're going to talk about that more in a minute because we had good retail sales numbers, and like I said, I'm going to talk about that more in a minute. What I want people to ponder there is like, well, what does that really mean? Well, okay, we had good retail sales numbers. Makes for a great headline, right? Like if you're trying to put clickbait out there, or you're trying to, oh, hey, let's splash a headline across the front page. Oh, hey, retail sales are great. People are out there spending money. But yeah, is that really? Is that really? Are people really out there doing that, or is there something else going on there? So. Okay, let's run through a couple things real quick before I shift gear to some of the other news. So Citadel Credit Union pays a $6.5 million fine to resolve the first Department of Justice redlining case against a credit union. So I thought this was really interesting because it was the first of its kind. Its first credit union here. So Citadel Credit Union has agreed to pay over $6.5 million to settle what the U.S. Department of Justice says is its first redlining action against a credit union. Prosecutors said that the Exton-based, so Exton's just outside the Philadelphia market here, Exton-based Citadel engaged in a pattern and practice of lending discrimination by redlining predominantly Black and Hispanic neighborhoods in and around Philadelphia. The settlement is still awaiting court approval. So redlining is an illegal practice in which lenders avoid providing credit services to individuals living in certain communities or zip codes because of the race, color, or national origin of persons residing there. So all major cities around the U.S., there's two big kind of key words you need to know. There's redlining, and then there's also a thing called block busting. So if you're in a major urban city, right, we'll take Chicago, right? Say a lender decides, well, we're going to lend in the south side of Chicago, and we're going to lend there because, we want to do the right thing. We want to help out the community and this and the other thing. So they go into the south side of Chicago. But then when they get there, they're like, yeah, there's a couple blocks here we want to stay away from. Maybe we don't like this block over here, or we don't like that block over there. Well, you can't do that. That's called block busting. When you're basically picking certain blocks and steering away from others, or refusing to lend on certain blocks, you can't do that. And then redlining works in a more broader sense. Redlining is kind of like, like you go into Chicago. Like I'll use Chicago again. I'm picking on Chicago tonight. You go into Chicago and basically say, you know what? We love Chicago, but we're not going to lend on the south side. Yeah, we're not going to the south side of Chicago. That's redlining. You can't do that. What happens is a bank has to pick a certain geographic area and say, this is our lending area. And then you have to lend in that area, and you have to lend in the whole area. So if you say, oh, I'm going to lend in Chicago, you've got to lend all over Chicago. You can't just pick and choose, where you want to go. And that's where banks over the years have gotten themselves in trouble. I just thought that this was interesting because it was the first time that a credit union had gotten tagged with redlining, which again, I just thought was interesting. Now, Citadel is much larger than your average credit union. Citadel has $6 billion in assets, $5 billion in loans, and over 260,000 members with 24 branches. So Citadel is a very, very good size credit union, kind of all over the Philadelphia region over here, if you were. And so they do a lot of, doing a lot of residential mortgage lending, and obviously got kind of nailed here. So again, thought it was an interesting article. Okay. SBA disaster loan funding will run out very soon, but you should still apply. So again, I wanted to put this article out there because the SBA's fiscal year end every year is September 30th. Something is happening this year, which always seems to happen every election year. And that is what happens is Congress goes away. Like, if Congress feels like they've been on vacation for 6 months now, it's why everybody, it's why everybody hates Congress and why Congress has like a 6% approval rating. Cause they go on vacation for 6 months out of the year. And so now you've got the SBA's budget is up. It's got to get reapproved. Of course, this unfortunately will get held hostage with a dozen other things that, the politicians will fight over who gets funding and when and whatnot. But this is particularly bad because, you've got people that are in these states that have gotten ravaged by these storms. You got Florida, you got North Carolina, South Carolina, Tennessee, parts of Georgia, parts of Alabama that have just gotten nailed with these storms, and they need disaster funds, disaster reliefs, and the SBA is kind of tied. So, but what the SBA is saying here is that they want you to continue to apply. Like, even though you may not get approved for the funds right this minute, make sure you apply for the loan, get the loan, because when the funds do become available, when they do get approved, then your loan is going to fund. And basically, so what you want to do right now is you want to apply and you want to get in the queue. You want to get in the queue, get in line, make sure you get your approval in there and that you're sitting there ready to go. So when the funding does come, you'll get a check right away. So again, I wanted to put that message out there. So for anybody who might be watching, if you got any loved ones that are in the affected area, or if you might be wondering for yourself, maybe you own a small business or something like that got affected by this, definitely spread the word on this, that don't not do it because they don't have the money to give you right this minute. Go out there, apply for the loan, and get in the queue. So, okay. And then here for this article, so this was on TD Bank. So I reported last week how TD Bank got just nailed for basically what was going on with their failure to look after what's called the BSA and the AML, the Bank Secrecy Act, anti-money laundering issue. Basically, they got hit with, just like Wells Fargo has an asset cap, TD Bank is now getting hit with an asset cap, which means they're probably going to be cutting back on some of their U.S. operations. So we'll have to see. But this article was basically said, they have sort of a straitjacket on, TD to cut 10% of U.S. assets after $434 billion cap instituted. So in the wake of its $3.2 billion fine and the imposition of a strict asset cap after pleading guilty to anti-money laundering violations, TD Bank said it will spend the next year focused on restructuring its balance sheet so it can continue servicing core retail and commercial clients. While the bank plays financial gymnastics to stay under the $434 billion asset cap, analysts say its impact could stifle both acquisitive and organic growth, reduce its earnings and stock price, and damage the company's reputation. For proof of those potential outcomes, it needs to look no further than the effects of a similar cap imposed 6 years ago on rival Wells Fargo and Company. So, this is a big scandal for TD Bank. This is a massive, massive scandal because this was not, there were hundreds of millions of dollars that were funneled through here. And this is the worst stuff. This was, Chinese gangs basically, pushing through fentanyl purchases and the pervading the flow of fentanyl drugs throughout our economy, which of course is killing tens of thousands of people, if not hundreds of thousands of people every year. And and then you've got the whole issue of sex trafficking and all this other stuff going on there. There was just a lot of just really horrific things in this for TD Bank, and I think this is something that just like the sales scandal at Wells Fargo, this is going to haunt TD Bank for a while. This is not something that's going to go away overnight. This is going to haunt them for a little while here going forward, and it'll be interesting to see what happens here. I think this asset cap, just like they kind of talk about in this article, they're going to be forced to have to pull back a little bit here in the U.S. Does that mean maybe shaving off some branches, reducing some employee count? Most likely, I think that's probably what you're looking at there. They're not going to be growing at all in the next few years because of this asset cap. So, I mean, this is definitely going to hit them pretty hard. What I wonder about, and what I keep saying is, I think there's a lot more to this story than what has been reported on, because the way I see it, a lot of these things could not have gone on unless there were certain people either being bribed or certain people involved in facilitating this. Because from my understanding, from other things that I've seen, is that there were a lot of text messages on TD Banks, like they have like an internal chat system. My understanding is that basically texts that were going back and forth, a lot of employees, like, on the front end of things, were basically just pointing out to their supervisors, hey, this looks like blatant fraud here. This looks like blatant anti-money laundering. This looks like, or this looks like blatant money laundering. This looks like blatant, trafficking. This looks like, I mean, all this stuff is like illicit activity. And, they're reporting this stuff, and it was going up to higher up people, and they just weren't doing anything with it. They were turning a blind eye to it. And it just leads. So all I'm going to say is this: I wouldn't be shocked if in the next year or so, we start getting some articles or some reports come out that turns out that this thing was a lot worse than what we were seeing or what we're reporting here. That's just a guess. It's just a hunch. I'm just making that, I'm not, I don't have insider information. I don't know anything. I'm just making a guess here. I'm just making an educated guess on kind of what I'm seeing here. So, okay. Hot button topic time. You guys ready? Biden has now forgiven 1 million student loan debt for public servants. I have a massive problem with this. And there's a couple of different angles here. Number one is the Supreme Court already shot this down. They already shot it down. So what he's doing is it's ridiculous that basically the Supreme Court says you can't do that, and he doesn't care. They're just doing it anywhere. It's just like, hey, whatever. We're just going to continue to forgive these loans. We don't care. There's been a number of judges that have shot this down. There's lawsuits and things continuing to go on. They don't care. Just keep on going with it. Whatever. And what bothers me about this is the word forgiven. It's not forgiven. It's just you took somebody else's debt and now you made all the taxpayers pay for it. This is socialism at its finest. And you're not nothing. There's no such thing as a free lunch. There's no such thing as a free lunch. Okay. Nothing is free. Nothing's forgiven. It's just, you just passed your bill on to everybody else. It's now the rest of society's burden to pay for your college education. I think that's BS. I think that's BS. I went to school. I've paid back over $100,000 in student loan debt in my lifetime. And I paid that back. No company paid that. I paid that myself out of my pocket. And it was my choice to do that. It was my choice to go further my education. It was my choice to go back and get an MBA. It was my choice to go back and get a doctorate. And I was totally fine with that. I was happy to pay the bill. I was happy to go out, earn those degrees, get that education, and then pay the bill because I wanted to do that. I chose to do it. Nobody forced me to sign on the dotted line. Nobody twisted my arm behind my back and said, you better sign these papers. No, I chose to do that. You chose to go to college. You chose to sign these student loan papers. You chose to take that debt out. Nobody put a gun to your head and forced you to do that, So so and then you get on to, well, what about the next person down the road? Like, okay, you forgave this person's debt, and now you're setting a horrible precedent, because now you got the people that came before going, well, wait a minute, what about me? Like, I did what I was supposed to do. I took out a loan, I paid it back. What's the deal here? So now so you got the people that came before who were going, this is messed up, I'm not happy with it, what's up with this? And now you've got the people that are going to come after. The people that are come after and go, okay, you forgave their debt. Where's my debt forgiveness? How come they got their debt forgiven, but I'm not going to get mine forgiven? Like, you just this whole thing is a giant fiasco, and I just the precedent that they're setting for this is a horrible precedent, and it's going to take this down. It's going to take us, what I'm hoping is not down a horrible road here at some point, And look, some people will disagree with me on this, and that's fine. That's fine. Everybody's entitled to their own opinion. Some people could sit there and say, "Oh no, hey, I got my loans forgiven and this and everything." Well, hey, okay, that's great. I don't think it's right. I disagree with it, but that's but it's not right. You're setting a horrible precedent here, and I just, like I said, I can't believe that that they're just, again, blatantly doing this after it's already been shot down by the Supreme Court. I mean, it's just to me, it's unreal. But okay. All right. Next thing here. Consumers have economists optimistic about third quarter growth. So retail sales. Now we get into the retail sales conversation. So retail sales rose 0.4% in September, coming in better than analysts forecast. The strong results could help push the U.S. gross domestic product, GDP, higher than expected in the third quarter. Online stores like Amazon helped boost sales, while furniture sales slowed as the housing market remained sluggish. So let me ask you this about retail sales. Inflation has gone up. A lot of things have seen cumulatively, inflation is up almost 20%, right, over the last 3 years here. You have to spend more to buy the same stuff. So it's what I'm saying here is it's an illusion. It's an illusion. You're paying more money to buy less stuff, and so it makes the retail sales numbers look bigger. So then they come out and they post this headline and say, oh, look, retail sales are up. The consumer's just out there spending, and it's wonderful and it's great. And look at how awesome the numbers are. No, it's not. It's not. It's a false number. That's not what's really happening. The inflation has driven up the prices of products for everything across the board. And people have to go out and they have to spend more to buy less. And that's what you're seeing. And so this, again, just like the labor numbers, just like and this is part of the reason why I say the GDP numbers are bogus, because of these kind of things that go on. We've seen a lot of the numbers, a lot of the economic indicators, the numbers have just been not good. They've been, they have not been as reported. So, okay. So we got that. So let me get rid of a couple of these things here. Okay, I want to get into, let's see here. We'll hold off on that for a second. Let me get recalibrated here for a second before we go on to our next thing. So, okay, I want to take a drink for a second. All right, guys, let's go on here. I'm going to read you guys some headlines here for a couple minutes here just to get some other news out there. So let's see what's going on. So we do kind of have earnings season right now, a bunch of banks reporting. So we had New York Community Bank unit Flagstar Bank implemented a workforce reduction plan as part of its strategic transformation initiative. As a result, about 700 employees, or 8% of the workforce across the bank's footprint, were impacted. The sale of Flagstar's mortgage servicing and third-party origination business to Mr. Cooper Group, Inc. is expected to result in a further reduction of about 1,200 employees. So, for anybody who doesn't know, New York Community Bank effectively had to get bailed out last year. They had a bunch of investors that came in, some high-profile people came in, basically dumped $1 billion into the bank, and they've been working on, righting the ship. They've been working on getting things. They sold off a chunk of their loan portfolio. They raised additional capital. They're going to be, I believe, changing the name here. I think I have that in somewhere here in the notes. that I have. And now they're going to be, doing a reduction of some of their employees here to basically continue to try to get the ship right, to get the bank back on, back on track there. So, okay, KeyCorp's loan demand has slumped as existing clients have not been borrowing. Chairman, President, and CEO Christopher Gorman said on an earnings call, yes, because loan demand is soft. Loan demand is weak. Truist Financial is planning to invest some of its newly padded capital and believes it can grow its return on tangible common equity faster than other banks, CEO William Rogers said during an earnings call. I'll have more information on that in a minute when we go through some other articles. Columbus, Ohio-based Huntington Bancshares has used credit risk transfers to help build capital levels and will continue to consider using the transactions. The Office of the Comptroller of the Currency, or the OCC, entered into a formal agreement with Maitland, Florida-based Axiom Bank for unsafe or unsound practices, including those related to the Bank Secrecy Act anti-money laundering compliance programs. So, the reason why I thought this was important is because it's not just TD Bank that the regulators are looking at. The regulators, they're looking at every bank across the board and basically saying, is anybody else not complying with BSA or AML? So it's a huge hot button topic with regulators at banks right now. So, Berkshire Hathaway once again reduced its stake in Bank of America Corp by selling about 8.7 million shares for approximately $370 million. According to a regulatory filing, the sale reduced Berkshire's stake in the bank to below 10%, which means the former would no longer be required to report any further stock trades in a timely manner. So Berkshire Hathaway, Warren Buffett, probably, the richest investor in the world. Warren he's been selling off his shares in Bank of America. He's been reducing those shares. He's building this giant war chest. But the important thing here is that they're now below the 10% kind of regulatory threshold. So by owning more than 10%, they would have to report those sales and trades in a timely manner. And now by being below that threshold, they now don't have to report. They can kind of report it as they want. So kind of an important thing there. But I think the bigger story is that Berkshire continues to unload shares. It continues to build the war chest. Why is Warren building that war chest? It would consider, you would think that he was doing that because he sees something on the horizon. He sees something's going to happen there, and he wants to be ready for it. He wants to have a lot of cash to be able to buy stuff up on the cheap. Goldman Sachs Group partnered with private equity giant Blackstone to create new form of debt packaging private fund loans into bonds, Bloomberg News reported, citing a person with knowledge of the matter. Last week, the firm sold $475 million in bonds backed by loans that banks make to investment funds, according to the report. Now, that is actually a very, very important thing. Why is that important? Well, we have had this kind of new area, if you will, of the market called private credit. Private credit is basically just hedge funds and private equity funds buying loans from banks. And banks are happy to basically unload bad loans right now onto these hedge funds and private equity. So I have been asking the question for the better over a year now. Okay, well, that's good for banks because they unloaded their riskier or potentially bad loans onto the hedge funds and the private equity. But why would private equity and hedge funds, why would they buy loans that they know are going to go bad or at the very least are going to be a major problem and be a huge headache? Why would they do that? And I've been asking that for a while now, waiting for an answer. Well, this is the answer. This is what's going on. They are now going to package those loans into bonds, and then they are going to sell them to investors who want to buy them. Does this sound familiar? Basically, I remember a time back in 05, 06, 07, when basically banks and, mortgage companies were basically taking mortgages, selling them, and then they would be bought up by Goldman Sachs. They'd be repackaged into mortgage-backed securities and then cut into different tranches. Anybody see The Big Short? And then sold off to investors. Everybody passing the buck, collecting their fee on the way. And as that thing just continues to get pushed down the line. And then when it all goes bust, the investor is sitting there at the end of the day holding the bag, going, oh man, what am I going to do? I just lost it. And they're calling up going, who owns this mortgage? Nobody knows who owns the mortgage because it's been repackaged and sold 10 times over. And that effectively is what is going to start happening now. So basically the private equity and the hedge funds, they've bought up these loans from the banks because they had to feed this beast of this private equity business division or whatever you want to call it. And so they have to feed the beast and they got to feed these loans in. But then they go, oh, wait a minute. These loans are bad. They're junk. We got to get rid of them. So now they're going to package them. They're using the old school techniques. We're going to put them into bonds and we're going to sell them off. And isn't that wonderful? So when these things blow up and the hedge funds and the private equity and some of these banks come back looking for the bailout, and it is going to happen. I can promise you, as the sun will come up tomorrow, this is going to happen. You'll have all these investors that are left holding the bag while, these guys get the bailout. It's like, we've seen this movie before, as they say. So, okay. The Federal Bureau of Investigation, the FBI, arrested Eric Council Jr., an Alabama man, and charged him over the January hack of the U.S. Security and Exchange Commission's X account and the premature announcement of the approval of Bitcoin exchange-traded funds, ETFs, according to a statement from the Department of Justice. So this gentleman basically hacked the SEC's X account, and then he prematurely announced the approval of Bitcoin exchange-traded funds, ETFs. So kind of interesting. I don't know. We'll have to see what happens there. Okay. Let's see here. We got some earnings information here. So Truist Financial reported third quarter net income available to common shareholders of $1.34 billion, up from $1.07 billion. Not doing too bad. Their provision for credit losses was $448 million, compared with $451 million for the second quarter of 2024. JP Morgan Chase and Company is selling a significant risk transfer associated with a loan portfolio valued at approximately $3 billion. Bloomberg News reported, citing a person with knowledge of the matter. The size of the risk transfer is estimated at around $250 million. The deal terms are currently being negotiated with potential investors. Unnamed sources told the news outlet. First Horizon Corp signaled net interest margin volatility ahead as the company works to attract and retain deposits while reducing asset sensitivity in a shifting interest rate environment. I'll talk more about that here in a couple minutes. Visa and MasterCard have entered into a new agreement with the government of Canada, under which, starting October 19th, credit card accepted cost will be reduced by an average of 27% for small businesses processing less than $300,000 in annual Visa sales and $175,000 in MasterCard transactions, according to a release by the Canadian Federation of Independent Business. Small firms will benefit from a 0.95% average interchange rate for in-store transactions and a 1% reduction in economic fees. Interesting that they're doing that in Canada. Why not in the U.S.? So I don't know if maybe they're just testing this. They're maybe using Canada as a kind of a guinea pig and see if they maybe see how this goes or see how it works, whatever. I don't know. We'll see, but it's just interesting. Robinhood Markets, my favorite company, Robinhood, is remaining active. Robinhood and CBOE Global Markets said Robinhood customers will soon have access to CBOE's index options on its platform. So Robinhood continuing to build out their product offerings for their customers. And then we got some FDIC news here. So the FDIC appointed Hansel, if I say this guy's name right, Cordiero. I think I'm saying that right. Hansel Cordiero, director of its new Office of Professional Conduct. The office will be a single point of entry for employee complaints of harassment and other interpersonal misconduct. So if you recall, FDIC a few months back, huge scandal. They had, third-party company come in, basically analyze what was going on, found out there was all kinds of sexual harassment. Whistleblowers weren't being listened to, weren't being treated well, or some of them were being booted out the door. People were basically being silenced. There was this horrible work culture. They did a survey, almost 75% of the employees were all ready to quit. It was a huge, nasty thing. So they've now created this new department within the FDIC and appointed this new gentleman to run it. And basically, this will be the office. If somebody has a complaint, they'll go to this office. Meanwhile, we have the chairman of the House Financial Services Committee, Patrick Henry, sent a letter to FDIC Chairman Martin Grunberg, who was responsible for all this whole mess, demanding he schedule a transcribed interview with the committee by 5 p.m. on October 16th, which was a couple days ago. I didn't see any word that he had responded or done anything, but this gentleman, I said before in past episodes, Martin Grunberg, he should have stepped down. He should have resigned immediately, but unfortunately for political purposes, he said basically, no, I'm gonna stay on and just stay here probably through the election, whatever. But I mean, this guy came out originally and said, oh, I'm gonna fix the problem. I'll make sure it's okay, yada yada yada. And it's just he should have been gone immediately. He should have been fired, out the door, see you later. But yet he has been, because Washington is what it is, he's allowed to remain. Okay, New York Department of Financial Services Superintendent Andrea Harris released a guide to help registered companies address and combat cybersecurity risks emerging from the use of artificial intelligence. The guidance does not introduce new requirements, but helps covered institutions meet their existing obligations in the agency's cybersecurity regulation in light of evolving risks from AI. So I'll have to take a deeper look at this and see if there's anything more that's good in there that I can maybe bring back and share with everybody. And let's see here. This is interesting. The Consumer Financial Protection Bureau's non-bank registry that tracks repeat corporate offenders will go live this week, sparking worries that companies may resist enforcement actions to evade public scrutiny. American Banker reported the Conference of State Bank Supervisors has consistently opposed the registry, arguing that the CFPB overstepped its authority and that the existing nationwide multi-state licensing system already identifies non-banks under public orders, the report said. So, they created this non-bank registry, and they were going to do it because they wanted to try to track repeat offenders. So we'll see what kind of happens with this. I think this will be very interesting to see how this all plays out in the coming months. Will this thing work? Will it not work? Will people press back on it? I don't know. We'll have to see, kind of what's going on there. So what else do I got here? Already kind of talked about that. A lot more earnings news. Okay. Producer prices flat in September. So the producer price index was unchanged in September after it increased 0.2% in August, according to the Commerce Department. The PPI is up 1.8% over the past year, but down from 1.9% the previous month. But what they didn't talk about was the core PPI. The core PPI increased for the second month in a row, and that is the important number. Again, just like with retail sales, kind of misleading with the headline. The PPI, it was okay. It was flat. It only increased 0.2%. Yes, the main number did. The core number, however, increased a lot. And a couple days ago when this came out, you saw the market reflect to that. Consumer sentiment dips in October. So consumer sentiment decreased 1.2 index points in early October, but is up 8% from a year ago. So why would, in other words, if retail sales are so great and if the labor market is so great, why would consumer sentiment be dipping, right? Like this, and this is where you begin to see the disconnect in these economic indicators. All you really need to understand is that things are nowhere near as rosy as what they appear to be. Okay, talked about TD. This was kind of interesting. Here's a good one for everybody. So Dallas-based blockchain data company Arkham Intelligence Inc. is planning to launch a cryptocurrency derivatives exchange for retail investors next month. Bloomberg News reported, citing a person familiar with the initiative. So I definitely want to keep an eye on that. That sounds very interesting, and we will have to see if anything interesting comes about with that. So, okay, let's take a look at some other things here. Get into, okay. So, do I have this? Okay, let me share this with you guys. I thought this was interesting. This came No, I'll get back to this chart in a second. Where's my other chart here? Did I get rid of it? Oh, no. You know what I need to do? Hang on a second. Let me share something else with you guys for a second. Aha, this is what I wanted to show you guys. Okay, so I thought this was interesting. This comes from a publication called Food Trade News. And basically this talks about like what retailers and the food business, like what are they doing? Like what are they building? What are they working on right now? So we can see, and I think this points to some of the interesting things that are going on. So you can see Aldi is basically 23 stores right now in their pipeline that they're looking to build. Amazon Fresh looking to build 4 stores. A company called Big Y, a couple stores. BJ's, a couple stores. Costco, only 1 store. DeChico and Sons, 1 store. Food Bazaar, 1 store. Giant, which is a food store, looking 4 stores. Grocery Outlet, 6 stores. H Mart, 1 stores. Lidl, 21 stores. ShopRite, 6. Sprout, 6. Stu Leonard's, 1. Target, 15. Trader Joe's, 5. Wegmans, 3. Weis Market, 1. Whole Foods, 8. So, I mean, and the reason why I wanted to show this was because, I mean, you know, Target, 15 new stores, okay, but I mean, they've got pretty much the market built out, right? I mean, they got 1,000, you know, I don't know, 1,000, 2,000 stores, whatever, across the country. So they're pretty developed here. But you obviously see the 2 big players right now that are very active. Lidl, looking to be very active with 21 stores, and Aldi with 23 stores. Amazon Fresh, which is the new concept from Amazon. Like Amazon, for people who don't know, Amazon owns Whole Foods. So this Amazon Fresh is kind of like if you want to consider it like the technology version of Whole Foods, you know, that's the store with the, you know, they were basically people could go up and they could scan their hand, like their palm print, and pay for food and stuff like that, and just walk around the store and just take stuff, and just, you know, they didn't have to go to a register to check out and that kind of thing. So like I said, interesting concept. Hasn't really taken off or been anywhere near as successful as what Amazon was hoping it was going to be. So that kind of got, you know, that's kind of gotten, you know, pushed off there by Amazon more recently over, I'd say, the last year or so. So will that kind of pick up as Amazon starts to work out some of the kinks in there? I'm guessing it will, but I don't know. We'll see. But like I said, I just thought this was an interesting chart showing activity of a lot of these retailers there. And again, this is really more focused on the food industry. So, but it just shows you kind of who's active out there right now, you know, in different parts of the country. So okay. So interesting stuff there. All right. So let me get out of that and let me go back to my other screen here. Sorry if everybody will bear with me there for a second. Okay. So now I want to talk about the Federal Home Loan Bank for a moment. So, and then I'm going to talk about the ACH network for a second. So interesting stuff here. So the article that I have here says that the Federal Home Loan Bank helped 65,000 with affordable housing. So the Federal Home Loan Bank's affordable housing and community development assisted nearly 65,000 low and moderate income households and supported more than 400 targeted economic development projects in 2023 through grants and advances, according to a Federal Housing Finance Agency report. The report highlights the FHL Bank's performance and activities under the Affordable Housing Program, the Community Investment Program, the Community Investment Cash Advance Program, and additional voluntary targeted mission activity programs. It also measures the growth in Federal Home Loan Bank membership and advances among non-depository community development financial institutions. Now, I believe that the Federal Home Loan Bank was putting this out because of what I'm about to read to you in a minute. So, in other words, I think this article was being put out because the Federal Home Loan Banking, how do I want to say that? Like you have the Federal Reserve banking system, which is what 12 banks around the country, and you've got the Federal Home Loan banking system, which is basically 8 banks around the country that basically serve thousands of, the Federal Home Loan Bank system serves thousands of banks around the country. It's very, very critical to the kind of inner workings of the banking system, if you will. And I think that they were looking for some positive press here. They were basically looking to show that, hey, our programs are working. Things are going very well. We're having a lot of success reaching out to a lot of people. And this is why they're doing it. So the Federal Home Loan Finance Agency, which basically oversees the Federal Home Loan Bank system. And this was written by the ICBA, so the Independent Community Bankers Association and state community banking associations told the Federal Housing Finance Agency that its recent advisory bulletin to the Federal Home Loan Banks regarding credit risk management expectations for member institutions lacks both clarity and statutory authority. And a joint letter to the FHFA, ICBA, and other groups expressed concerns that the advisor bulletin lack clarity, creates uncertainty, and could disrupt community banks' access to the Federal Home Loan Bank system. The groups also emphasized that community banks rely on the Federal Home Loan Bank advances for liquidity and oppose any regulatory action that undermines community bank access to that system. The FHFA last month sent an advisory bulletin to the Federal Home Loan Banks that detailed expectations for providing member access to advances in a safe and sound manner. So ICBA's view on this is that they are deeply concerned about the impact of the FHFA's ongoing review of the Federal Home Loan Bank mission and its impact on the ability of the system to provide liquidity to community banks. So this has been kind of an ongoing conversation basically throughout the year now, and it's a very, very big thing. How do I want to say this? I am a fan of the Federal Home Loan Banking system. I think it is a system that has worked great for, however, I think the Federal Home Banking system's been around for 100 years. And as a matter of fact, if we scroll down here at the end, there's a paper that they put out called the Federal Home Loan Bank System at 100, focusing on future report. And that was put out in November of 2023. And I do have that report. I'm definitely going to go back and do an episode on that report, because I would like to do an episode talking about the history and the background of the Federal Home Loan Banking System, why that is so important to the banking system as a whole. So, I'll explain it like this. Every bank has a line of credit, right? And there are two ways that banks can basically get lines of credit. They can go to the Federal Reserve and they can get signed up for what's called borrowing at the discount window. And I did a whole episode on this. I did a whole episode on the federal discount window, how banks can sign up to it, what they need to do, why they should do it, and stuff like that. But what I want to point out to people is that, the Fed is considered the lender of last resort. And they didn't always make it easy for smaller banks to get access to the discount window. For a long time, it was basically the prime banks, what they called the 24 prime money center banks, that the top 24, 25 banks in the country. Those were the ones that were basically getting the main access to the discount window. But over time, they opened it up and said, hey, basically any bank can come in and now apply for it and get access to the discount window. But the problem with the discount window is that there is a stigma. There's a stigma with it because the Fed is the lender of last resort. So people over the years, because of the different crises that have happened over the years, over the decades, and basically, people look at it, right or wrong, that like, oh, well, if you're going to borrow from the Fed discount window, then there must be something wrong. You must have something wrong with your bank. There must be some big problem. And so a lot of banks have steered away from it. Now, what's the other way that a bank would get a line of credit? Well, they get it from the Federal Home Loan Bank. That's where most banks in the country, if they want a line of credit, they go to their, kind of area Federal Home Loan Bank. They sign up, they get a line of credit, they pledge collateral for the line of credit, and then they go from there. And then they borrow as long as they stay within their parameters. Everything is okay. The bank's doing well, that sort of thing. So what happened that kind of kicked this whole thing off was when we had the banking crisis last year. In March and April last year, when Signature Bank failed and Silicon Valley Bank failed and Silvergate Bank failed, when all those banks went out, First Republic Bank failed. Like, well, when that happened, I believe it was Signature Bank basically went in. They had borrowed from their Federal Home Loan Bank line of credit. And a lot of people basically came out and said, hey, they probably shouldn't have done that. Or why did the Federal Home Loan Bank, basically approve that line advance when they knew that this bank was on the verge of failure? So it basically kicked off this conversation of like, well, when should a bank be able to borrow funds? When should they not be? How is the Federal Home Loan Bank kind of monitoring those banks? Is there maybe some type of bias involved here as to what's going on? So that kind of is what kicked off this whole conversation and why we've gotten to, where we are today. But I believe that a lot of what the FHFA is doing is very misguided, and they're kind of it gets back to that old saying of like, if it's not broke, don't fix it. The Federal Home Loan Banking system is not broke. They do an excellent job. They help out thousands of banks across the country. They have they help thousands of banks day in, day out, week in, week out, year in, year out to basically perform, do all the things they need to do to service their customers and move on. So. So I just think that this thing is kind of, over the top a little bit, so to speak. So, okay. Let's take a look at ACH volume. I thought this was kind of cool. Okay. So let me make this smaller for just a second so people can kind of see this. So this is a chart here on third quarter 2024 ACH network. Nacha. I love that. I love that name, Nacha. So Nacha puts out this infographic, and so this is for basically debit cards and credit cards. So, and now here's where I'm going to kind of, so I got everybody to kind of see this. So basically this is like total volume, same day ACH volume, and then down here volume across major transaction types. So let's zoom in here for a minute so everybody can see this. So let's take a look at the first thing. So third quarter 2024 total ACH network volume was 8.4 billion, 4.7 billion debit card transactions, 3.7 billion credit card transactions. Same day ACH volume over here, we can see that this increased 67.5% over the third quarter of last year as value rises 38.8%. And so you can see here from the volume that basically you had credit card volume, 212 million, and you had debit card of 355. And then over here, value here, basically 608 billion for the third quarter of 2023, 855 billion for the third quarter of 2024. So the basically use of electronic debit and credit cards continues to expand. And then let's see here the volume across these different major transaction types. So internet volume was up 9%, 2.7 billion. Direct deposit was up 3.9%, 2.1 billion. Healthcare was up 7.8%, 132 million. And then finally, P2P, peer-to-peer payments. That could be Cash App, could be Venmo, PayPal. Venmo is owned by PayPal. So it could be Zelle, Venmo, Cash App, that kind of thing. So peer-to-peer was up 20% at 99.6 million. So basically, yeah, ACH network, Nacha is a really cool organization. They've got a really neat website with a lot of fantastic information. Anybody who's interested in kind of the payment ecosystem, as it were, in banking, I think there's a lot of great information there. Certainly a lot of material for me to do some episodes, some single episodes on, because there's a lot of great, the kind of payment channels, as it were, is a very obviously hot topic in banking, but a very interesting topic to talk about in general. Just because of, so many people out there are so interested in this. So, okay. Let's see here. What else do we got? Yes, okay, so let's hop out of this. We've got a few minutes left here. So I want to run into a couple of things here. What else we got? FinCEN renews real estate geographic targeting orders. Yeah, okay. Let's see here. We talked about that. This is kind of interesting. ICBA urges congressional support of Middle-Class Mortgage Insurance Premium Act. So the ICBA and a coalition of stakeholders in the housing finance system encourage the House Ways and Means Committee chairman and ranking member to support homeowners by reinstating, making permanent, and expanding eligibility for the mortgage insurance premium tax deduction. So the ICBA and other groups urge the committee leaders to include a bipartisan, bicameral Middle-Class Mortgage Insurance Premium Act in any end-of-year tax package or 2025 tax reform legislation. So basically, this is kind of interesting. It's kind of an interesting act there. We'll have to keep an eye on it and see what happens there. So, okay, I loved this. I have talked about BOI, beneficial ownership information, a super hot topic. A lot of people really, really need to hear about this. I will be doing more episodes on this as we come to the end of the year, because for most small business owners out there, you are going to have to register by January 1st, 2025. So I will be giving more updates on this, but I hate this whole, the Transparency Act of 2022. I hate the whole beneficial ownership information, the database. I think it is completely unconstitutional. The National Small Business Association sued FinCEN over this and basically won their lawsuit. They won the lawsuit. The court basically said that the BOI database was completely unconstitutional, but yet this was only going to affect members of the NSBA who were members before they filed the lawsuit, which I think was in like the beginning of March of this year. So very few people or very few small businesses out there are going to be covered under this. But like I said, I'll have more information here. But here's the important thing that I wanted to point out. The Financial Crimes Enforcement Network, FinCEN, issued a final rule to clarify that certain telecommunications service providers qualify as regulated public utilities and are exempt from the Corporate Transparency Act's beneficial ownership information reporting requirements. The final rule is effective immediately upon publication in the Federal Register. So the CTA, the Corporate Transparency Act, requires certain entities, including many small businesses, to report to FinCEN information about the individuals who ultimately own or control them. So what I love about this is basically now you're starting, as we get closer to the reporting requirement, now FinCEN is basically picking winners and losers. They're basically picking out people that either complain or have political favor or whatever the case may be. In this case, the telecommunications service providers. Oh, yeah, you guys don't have to report on this. We'll make you exempt. Now we start to get the typical stuff where the government decides to make this industry exempt or this player exempt. But, all the small business owners out there, forget you. You better show up and you better register, because, oh, by the way, the fines on this thing are insane. It's basically like $500 a day. Can get hit with a $10,000 fine. You can get up to 2 years in jail. Let me say that again, 2 years in jail for not reporting to this thing. And of course, FinCEN says that we're not going to go after people or anything like that. We'll be nice and gentle and easy on you. Well, if you're not willfully ignoring, well, how do you prove whether you are willfully or not willfully not registering? Oh, what do you just show up and say you forgot? Oh, hey, FinCEN, I forgot. Is it cool now? I'm sure they're just going to be like, oh, yeah, it's fine. It's fine. Like, yeah. I hate this whole thing. So so more information to come on the whole BOI nonsense. Okay, let's see here. All right. Let's see here. I just want to wrap up with, let's run through a couple articles here real quick to kind of just blow through. So let me pull this up. So, okay. M&A activity in the U.S. and Canada falls in the third quarter as deal values rise. So now I just did an episode I did an M&A update, but that was for banking specific. This article is related to just M&A in general. So M&A across all industries. This is M&A across the U.S. and Canada, basically slowed in the third quarter as benchmark interest rates remain near their record peaks. The aggregate transaction value of the deals, however, rose from the previous quarter. So, M&A value continues to be somewhat muted there. And then let's see here. What does Goldman Sachs have to say? M&A advisory activity to pick up, says Goldman Sachs CEO. So Goldman Sachs Group Chairman and CEO David Solomon struck an optimistic chord on M&A during the company's third quarter earnings call. After consecutive quarters of rising advisory backlog, Solomon said he expects a continued resurgence of investment banking activity, including both M&A and equity issuance. Investment banking fees rose 20% year over year to $1.87 billion during the quarter, and advisory net revenues rose 5% year over year to $875 million. We are seeing increased client demand for committed acquisition financing, which we expect to continue on the back of the increasing M&A activity. So, what is interesting is there were a number of at least bank M&A deals that did get announced this week. So, it looks like things might be picking up a little bit in that area. So we shall see. If you want to get the more detailed analysis on that, go watch the episode I just did on bank, the M&A update, because I talk about what's going on in the M&A world of banking and what, reasons for, why has the M&A activity been muted? Why could it potentially pick up? What's the big issues are? So go check that episode out. You can get more, information there. So, okay. Bank stocks surge as the industry reports third quarter earnings. So U.S. bank stocks outperformed the broader market as the industry began reporting their third quarter earnings results. So let's see here. Best and worst performing bank stocks. So Unity Bank up 19.4%. Bank 7 Corp up 17%. That's nice. First Foundation up 15.8%. Kearney Financial Corp up 15.1%. Citizens Financial Services up 14.2%. New York Community Bank, who we talked about, up 12.6%. And then who's on the bottom here? OFG Bank Corp down 3%, which is really not that bad. William Penn Bank Corp down 2.1%. Main Street Bank Shares down 1.7%. Finward Bank down 1.6%. So not really too bad there. Nothing really too egregious on the downside. But the upside is very nice. We saw some banks here, bank stocks popping back here. And then we got some little bit more specific news here in a couple of these articles. So Truist aims to outpace peers on return on tangible common equity growth. So in other words, Truist raised some money and now they're going to look to put that money out there and try to get that money put to work. So there you go, in a nutshell. Regional banks, prudent on capital, even with record high levels. So basically, regional banks, capital levels looking pretty good despite, despite the fact that they are at record highs. So, but that's good. Let's see here. Anything else? Retail sales, we already talked about that. See here, banks' third quarter reports mark solid start to the rate cut cycle. Big bank earnings reports showed strength at the start of a rate cutting cycle with resilient spread income and jumps in fee revenue helped by a pickup in capital markets activity. Couple interesting articles on Fulton Bank. So Fulton Financial exits the indirect auto lending channel. So Lancaster, PA-based Fulton Financial Corp exited its indirect auto lending channel in the third quarter as part of an initiative to evaluate its business. The decision considered the company's focus on higher margin and relational products. Kind of interesting there. We expect this portfolio runoff to moderate consumer loan growth slightly going forward. So, question, did Fulton Financial see an issue in auto lending? Is that why they backed off? Maybe. And then let's see here. Fulton Financial is open to M&A activities in 2025. They're eyeing community banks. So basically, their Fulton Financial is a pretty good sized bank, $32 billion in assets. And they're basically going to be out on the hunt looking for banks that are basically in the $5 to $15 billion size. But primary focus, they may be on the hunt for banks more within the $1 to $5 billion range. So, continue to keep an eye out and see what happens there. U.S. Bancorp books $119 million loss on security sales in quarter three. So U.S. Bancorp anticipates a payback of roughly 2 years after recording a net loss of $119 million or $89 million net of taxes on the sale of certain investment securities. The company said it sold securities with roughly $10 billion of notional value. So they sold $10 billion, took a net loss of $119 million. They did this because they needed to reposition their bond portfolio. I have talked for many months now about how the banking industry as a whole has a problem with what's called unrealized losses in their bank bond portfolios. It's a huge industry-wide problem. Some banks have bit the bullet, so to speak, and basically sold and taken the loss to reposition their portfolios. So a lot of banks are trying to just basically ride it out and hoping for the best. But U.S. Bancorp finally pulled the trigger, and I believe they had one of the larger negative, bond portfolios of basically the probably top, 50 banks that had an issue. Obviously, the banks with the biggest issue are the four biggest banks. Bank of America's got like $110 billion potential loss on their bond portfolio. Like JP Morgan and Wells Fargo, I think, are both sitting probably about $30 billion. Citibank was probably sitting somewhere in that neighborhood, maybe 20 some billion, something like that. So just a good example there. Let's see here. Deposit trends flipping to a tailwind at Citizens after the Fed cut. So Citizens Bank basically sits here and says the bell went off when the Federal Reserve cut interest rates in September, and migration between low-cost deposits and high-cost deposits is transforming into a slight positive. The Citizens Financial Group Vice Chairman and CFO John Wood said the bank projected a sequential increase in fourth quarter net interest income of about 1.5% to 2.5%, and net interest margin expansion of about 5 basis points. Net interest income fell. Woods called the third quarter a trough during a conference call, and the bank's guidance anticipates a 40% deposit beta, or the move in deposit costs relative to underlying rates by the end of the fourth quarter. It still expects its cumulative beta during the rate cuts to match its beta on its way up at 50% to 55%. So just kind of interesting to note. I thought this was an interesting article just because it kind of talked about, all right, banks are getting ready for rates to drop, kind of thing. But Bank of America says it hit a net interest income inflection despite the rate cuts. So see what happens with that. And then finally, capital perks of credit risk transfers will attract U.S. banks even as rates fall. So the spread of a new generation of credit protection agreements among U.S. banks is likely to outlive cyclical factors that have spurred their adoption in recent years. Credit risk transfers, well established in Europe, have helped a growing number of U.S. banks strengthen capital during a time when rising interest rates were hammering the fair value of loans and bonds, doing the opposite. Some banks have said they are not likely to return to the market after meeting capital needs. However, the deals can slash risk-weighted assets, RWAs, at an attractive price and offer features that can make them more desirable than conventional securitization or loan sales, including eliminating questions about who controls relationships with borrowers and facilitating bespoke relationships with credit investors. Activity in the U.S. so far by early movers is creating a template. As deals start to close, others pay attention. So again, I think this is very interesting. So let's see here. Some of the banks: U.S. Bancorp, Huntington Bank shares, Ally Financial. You notice these are all auto. Valley National Bank, auto. SoFi did some student loans, did some warehouse healthcare here. But isn't it interesting that Fulton decided to pull out of the auto, and now these guys are selling off loan portfolios here for auto? Kind of interesting. We'll see what happens. So I'm sure there will be more to come for this credit risk transfer. Something we'll definitely have to keep an eye on here as we go forward. So, but okay, man, got through a lot there tonight. So that's all I got for you guys tonight. Unfortunately, that's all I got. But keep an eye out. Like I said, there will be I'll have episodes coming out next 5 or 6 more episodes coming out over the next 5 or 6 days. So keep an eye out for that. I'll be back next Friday night, with another live stream at 7:00. As always, I was trying to make this show as hopefully as consistent as I can possibly make it. Got some really cool things coming on the time horizon in the future. I'm going to be doing, like I said, I'm working on this whole financial history series. Hoping to have maybe the first episode for that come out maybe toward the end of November. We'll see. We'll kind of see what happens there. Or I may have to push that. I may decide to start it with the calendar year. I may decide to start that in January to kind of, kick it off in January and then run it every month through to kind of be its own little like season, if you will, like through next year, season one kind of thing. But we'll see. I'll figure that out here in the next couple weeks, and then I'll make, whenever I do decide to start that, I'll make an eventual announcement on that. But yeah, so that's it. So I'll kind of wrap up and just, give you guys the usual spiel at the end here. Just remember, we are on YouTube, Rumble, and all major podcast platforms. If you're liking what you see here, please please share, please subscribe. That really would help the channel, really help to spread the word here. Hopefully people like what I'm doing here, and hopefully I'm providing some good information. I know it may be, all this financial data and news and everything may be a little bit of an acquired taste, but hopefully people will find it interesting, and like I said, hopefully find it valuable. Let me just see here. Let me just check on something. Did not have any comments here to go over, but like I said, so check out some of the other content on the channel. Please make sure to leave your comments, as I always love getting comments from subscribers and getting back to people. I really appreciate everybody out there that has been added a lot of subscribers here just in the last 90 days, which has been absolutely fantastic. Have had some very positive, very uplifting comments, which I just appreciate so much. It's nice to know that, people are seeing some value in what it is that you're trying to do or trying to deliver in terms of content. So I thank all the subscribers, all the watchers, the listeners out there. I appreciate you all, and thank you so much, and keep the comments coming. And I can't stress enough, if there's a topic that you want me to cover that I haven't covered, please make the suggestion. I've gotten a few suggestions from people so far, and have been able to put out some episodes that people really liked. So I really want to keep that, kind of train rolling. So please, if you have an episode that you would like to submit, and you can always email me at info@thebankernextdoor.com. That's info@thebankernextdoor.com. You can email me anytime at that email address. Send me suggestions, and I'd be happy to get back to you. But I hope everybody has an awesome weekend. And like I said, look out for those new episodes, and I will be back again next week. See everybody again real soon. Thanks a lot.